Most UK business owners don't know much about ordinary shares. This can cost them control and money later on, especially when taking on business partners or investors. I'm Zoppi, an English qualified solicitor, and in this video, we'll discuss ordinary shares. We will go over three main things. First, what are ordinary shares? Second, what rights do ordinary shares typically have? And lastly, who are ordinary shares for? Fantastic, let's get started. So chapter 1 is, what are ordinary shares? In short, ordinary shares are the most common type of company ownership of type of share. They give you a piece of the business, a piece of ownership of the business, a share, a slice of it. Think of it like buying a slice of pizza. Each ordinary shares is one slice, and the more slices you own, the bigger your portion. Most UK companies start out with only having ordinary shares because they're simple, flexible, and they work for most situations. Fantastic. Let's move on to chapter 2, which is what rights do ordinary shares have? Ordinary shares give you three key rights: voting, dividends, and capital distributions. Voting lets you have a say in important decisions. You get to vote on a specific matter. Dividends give you a cut of the company's profits. So once the company has turned a profit, paid corporation tax on those profits, what's left is going to be distributed as dividends to the shareholders who have the right to receive dividends. And lastly, we have capital distributions, which protect you in case the company is liquidated and its assets are sold off. If this happens, then you get to receive a cut of the proceeds, aka a distribution from the capital of the company. As a fun fact, one ordinary share usually means one vote, but you can create different classes of shares that, for example, have more than one vote per share, like management shares. Now, before we discuss who ordinary shares are for, feel free to email me if looking for professional legal advice. With our legal advice calls, there are no charges, no obligations, and no nonsense. Contact me now at info@zoppi.co.uk. Fantastic. So, chapter 3 is, who are ordinary shares for? Well, ordinary shares are usually reserved for the founders, but in less complex and smaller companies, they can also be used for investors and even to incentivize employees. So, founders use them for control, investors want them for capital growth, so they're betting on the company increasing in value, and employees again get them as incentives. Important is to think about your goals first. So, if you want simplicity and full participation by all shareholders, then ordinary shares for everyone are perfect. But sometimes you need different classes of shares. For example, if you want to engage in tax planning or to retain more control for the founders. Accordingly, as a pro tip, you might want to consider using alphabet shares, so different classes of shares, to increase your flexibility. So that's how ordinary shares work. But if you've got any questions, feel free to put them in the comments below, and I'll be happy to answer any questions that you may have. If you want to learn how to create different classes of shares, be sure to watch this video right here. Thank you for watching.